Contrarian investing has its advantages, as at earlier I discussed in a particular video of mine. But we should not forget the fact that these strategy equally, possess uh, its own disadvantages as well. And so here are some core key challenges associated with this particular strategy. We want to analyze the disadvantages of contrarian investing. Number one is increased risk. Investment, as we all know, is risky, and contrarian investing is not left out. Contrarian investing often involve, going against prevailing market trend, going against what the entire market, other market participants are doing, which on its own can be risky. If the market consensus turns out to be correct, investments may continue to underperform. That is why we have to be very, very careful, because other participants, the crowd, are most of the times right. And so if you are wrong in that analysis, you end up losing your money. But if you are right, well, you can end up making money. So you are going against a prevailing trend. Make sure that your opinion, your point of view, as it relates to a particular stock, is right. If it's not right, then you may run into problems. Number two, extended holding period. When it comes to this particular strategy, investment based on contrarian strategies can take a long time to pay off. Unlike day trading, that is a matter of a daily affair, a daily event. When it comes to this particular strategy, it takes an extended period of time for you to be able to realize, the value for your money. The market may remain irrational or pessimistic for an extended period of time, requiring patience and tolerance for short-term losses. For the fact that you are investing for the long term, you may accumulate short-term paper. I want to emphasize paper losses. As long as you don't sell, it is considered paper losses. So don't worry. These are the kind of things you face as a contrarian investor. It's a long-term based approach, and it comes with its own disadvantages because of the losses you're likely to incur, as you wait patiently. Number three, market timing challenges. Successfully implementing a contrarian strategy often requires precise market timing, which is difficult to master. No investor, no matter how experienced you are, you cannot master market timing. That is, you will not understand precisely the very best time to pick a particular stock. That particular knowledge, I think, is beyond human ability. And so there's that challenge that you may not know precisely when to key into a particular investment. So misjudging the timing can lead to poor investment outcome. If you enter an investment, you buy into a stock at the wrong time, it might affect your outcome. You see, and that is a disadvantage we must always bear at the back of our mind. Number four, emotional and psychological strain. Holding positions that are out of favor can be psychologically and emotionally taxing. It's out of favor. That particular stock is neglected by the market. It's not popular. It is dumb. It's neglected. It's forsaken. And you are still holding on to that investment, still holding on to that stock. It takes emotional strength for you to be able to do that, And so, it also involves, enduring criticism from others and dealing with market volatility. The people will laugh at you, say, look at this investor, look at this person. You are buying something that other people are dumping and neglecting. What are you doing there? What do you think you're going to gain by holding that particular stock? So they will laugh at you, just like they were laughing at Warren Buffett during the dot-com boom. That Warren Buffett is outdated, this and that. Eventually, during the dot-com bust, Warren Buffett, being a contrarian investor, was able to make huge amount of money because he stuck to this strategy. When people were buying high flying tech stocks, telecom stocks, Warren Buffett stuck to his value investing, contrarian investing, and then the entire market was wrong, and he was right, and he made ton of money. So sometimes being alone can be emotionally lonely, psychologically tasking and straining. What will you do? That is what it takes to be a contrarian investor. Number six, number five rather, potentials for greater volatility. Potential for greater volatility. Contrarian investments can experience significant price swings, which may be uncomfortable for investors with low risk tolerance or who may prefer a more stable investment. When you see your market, your stock going up and down, swinging up and down, it can be very, taxing emotionally. You are exposing yourself to that kind of investment. But then what do? You have to hold tight, you know, despite the fact that you may prefer something that is more stable. But for the fact that you envisage you are going to make a greater amount of money, you hold on to what? To your contrarian position. All things being equal, you will eventually, create wealth as a result. Number six, misjudging the markets. Misjudging the market. There's a risk of misidentifying true value opportunity. Sometimes what happened to be undervalued may be a reflection of an underlying problems that are not immediately, apparent to participants. Sometimes you may kind of misjudge what is happening. A stock may not be doing fine. If you don't really understand the company critically, you may not know precisely why the stock is not doing fine. There's a reason for why people are dumping that particular stocks. So try and identify the reason, or else you may key into the wrong investment, the wrong stock, and that will make you to lose money at the end of the day. There's always a risk of misjudging the market. And mind you that the crowd most of the times is always right. And so when they are dumping a share, don't just rush to buy. Understand why they are dumping that share before you now know what to do, whether to buy or not to buy. Number seven, liquidity issues. Investments in out of favor stocks or sectors may suffer from lower liquidity, making it harder to buy or sell position without impacting the market price. I want to speak from my experience as an investor. I've been investing for the past 18 years. I think I started investing around 2006. In fact, currently speaking, there's a stock, in my client's portfolio. I've been trying to sell for the past, I think either for more than a month. No liquidity. You always have people, investors, in the offer column, in the offer section, trying to sell, and you will not see even a single individual in the bid section or in the bid column trying to buy. I've been struggling to sell these stocks for a long time so as to rebalance my client's portfolio. Up till now, to no avail. So I've learned my lesson the hard way, and I must consider liquidity, not just being contrarian, but I must consider how liquid is this stock when it is time for me to sell. It's an experience, it's a lesson I've learned, and I believe I've assimilated, and it will help me a long way in my investment journey. Please don't forget to subscribe to this particular channel and press the notification button. Give me a thumbs up and share this video. Also, don't forget to comment in the comment section. It will help me, tremendously as a creator of content in this particular genre. Number 8, short-term underperformance. Contrarian investment may underperform for an extended period, which can be discouraging and can lead investors to abandon their strategy before it has a time to work. You may be right actually. You may be right in buying a particular stock, but you are being right in buying that stock doesn't guarantee that the stock is going to perform almost immediately. Sometimes it might take 6 months, sometimes it might even take a year, sometimes it might take as much as over a year. Okay, and so that is what you must bear at the back of your mind. And the period when the stock is not performing fine, you are incurring a kind of underperformance when it comes to opportunity cost. So that is a disadvantage you must consider when you want to adopt this particular strategy. Number 9, difficulties in analyzing trend. Trends could be very difficult to analyze, because you know identifying when to go against the grain, against the crowd, requires thorough analysis, experience, and can be challenging. You say, well, the crowd is going this direction, I want to go the opposite direction. It's not an easy decision. So it's a very difficult, task to analyze the trend and know precisely where the crowd is going so that you can, invariably take an opposite direction. It's not easy. It's not an easy task. So it involves assessing whether the current negative trend, is temporary or whether it is going to persist. That one alone is another level of knowledge, you need to undertake. Number 10, potentials for higher costs. So frequent rebalancing or trading to implement a contrarian strategy might lead to higher transaction costs and tax implication. You want to implement this strategy, frequently. You want to rebalance your portfolio as the crowd is dumping, you are buying. As the crowd is buying, you are selling. It will incur a high transaction cost as a result, and of course, the tax implication is there. Any tax gain, any gain, um, compounding within a short period of time will attract a higher tax, a higher tax rate. You must have this at the back of your mind as an investor.